Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We are honored at this moment to have a view of the American labor economy to speak to Claudia Sahm with all of her affiliations with Michigan, with her definitive, the Sahm rule. We're thrilled she could join us today from New Century Advisors. I'm looking at this report. First of all, Mr. Myron looks pretty good here on his path to 6 rate cuts. Very simply, the revision is a negative 76,000. That is a negative 26,000 combined statistic. The 3 months moving average. Thank you, Scott Landman and our team, Vince Gollinall, for this. The 3 months moving average change. Paul, look at that. Yeah. Negative 22,000.
Exactly. Claudia Sahm here joining us still, Chief Economist at New Century Advisors. Quick read from you, Claudia, on some of these numbers. I mean, I don't know, the unemployment rate ticked down to 4.4%.
Yeah, no, that is very encouraging. I mean, we've seen the unemployment rate moving up since the middle of the year. There were some reasons to think that maybe the November number, the 4.6%, was somewhat elevated with the government shutdown ending. And so it is reassuring to see some of that come back off. But it has risen over the course of the year. That is problematic. And then, you do point to these payroll numbers they're really weak. And next month, we're going to get the annual revisions in, which we know is going to take a good, chunk out of over the last year. So we do have this very slow job creation. Unemployment rates rising. It is very reassuring to see this steady march and the unemployment rate kind of take a little bit of edge off, but we're not all clear here. This is a very confusing and potentially risky picture.
Dr. Sahm went just right where I wanted to go. We're at Jackson Hole. She and I are looking out over, through the big window in the mountains in the background. Sure. And she's so delicate. She says, "Hey, stupid, it's about the revision report in February." Claudia Sahm, with futures up 15 here, folks, a nice lift to the market. Claudia Sahm, this revision coming up, you and Anna Wong have really, really emphasized. What do you glean from the new BLS about what that big revision in 30 days is going to tell us?
Right. Well, I think, there's going to be a large downward revision in the prior year. So we just haven't had a lot of job creation. Now, the unemployment rate has been rising, not dramatically. So there has been in payrolls, there has been kind of a slowing supply of labor and a slowing demand of labor. The slowing demand is winning out. The unemployment rate is coming up, but the picture looks much more ominous if you only look at payrolls. And maybe it doesn't look ominous enough if you only look at the unemployment rate. Like, you got to kind of put all the pieces together, but it's certainly a concern and a risk. And this is exactly what the Fed was responding to. I mean, they cut rates 75 basis points last year with inflation elevated on concerns about where. So this is also validating, I think, the Fed as a whole, like they were moving on concerns about the labor market, and we are seeing it in the data. Okay,
but Governor Sahm, see how I'm front running the next job for Governor Sahm? If you look at the 3 rate cuts in all, it's a nonlinear function. I mean, when does a 25 beep rate cut kick in to advance that demand for jobs, to get job formation going again?
Right. Well, and I think this is where the Fed really took the view of front loading these cuts on concerns about where the labor market might go. That really raises the bar for them to do more cuts in January. It's kind of like they took an effort there, and it takes time for that to work its way through the economy. They're looking out at seeing some fiscal policy that should come online, that should be somewhat supportive early in this year. Like, we have the ingredients here to stabilize the labor market, get hiring, back on track, but we don't really have many signs of that happening yet. Right. But the Fed has kind of done their work, and I think they're going to want to see how this plays out, keeping a careful eye on it. But the fact that we saw the unemployment rate tick down, that gives them some breathing room.
We continue with Claudia Sahm. Futures advance up 14.50, now up 21. A bid to the market. Dow futures up 130. Oh, and I don't have a 50,000 on futures print right now on Dow, but it's remarkable we're there. The VIX comes in constructively. 15.23. The Sweeney yield was shockingly unched here. I wonder if that's a typo on the Bloomberg, but a little bit higher yield structure. I noticed dollar strength as well. Oil on Venezuela really not doing much today. Gold, you're kidding me, Paul. Up $36, near $4,500 an ounce. Sweeney with Claudia Sahm.
Claudia, let's look at the wage side here. Average hourly earnings on a year-on-year basis up 3.8%. That's above the consensus. That's pretty solid. Consensus was 3.6. The revised last period was up a little bit to 3.6. So 3.8% earnings growth. What do you make of that?
So, I mean, that's a bump up. And yes, that's above expectations. I think it'll be, always kind of concerned about 1 month and looking at composition. But, that we've seen big picture, we've seen moderation in wage growth, but it's been very gradual, right, over time. So that does, fit within the,
right.
Wage growth still, and this is still elevated, which does fit with, productivity is higher too. So I don't think this is a number that would necessarily cause concern about, spillovers to inflation, but it is, something to keep an eye on.
So you've alluded to this, but to you, is the January meeting now we got CPI, but is the January meeting now a bigger deal, or is Claudia Sahm out to March and beyond?
Well, every meeting is a live meeting, but to me, they really put effort into getting the rate cuts done last year, putting together, even though there were questions about should we wait for more data? Is it really necessary? Yeah. I think this front loading, which is a smart thing because the Fed policy takes a while to take in effect. So I think to get that done, there's probably going to be we want to really assess the situation. So I don't see them having their urgency with January, particularly with this report today.
Claudia Sahm with us, and we continue commercial free in this hour. Michael McKee coming up. Kristina Campmany comes in the studio and drops everything. She dropped Lisa's breakfast. We'll get to her in a moment. With Invesco as well, we're going to continue with Dr. Sahm. Paul, we continue with the bid moving up. Futures up 24.
Absolutely. Claudia, we're going to get some inflation data coming up soon here, just on the other mandate for this Fed. Kind of, what are you looking for there?
Yeah, we had the last inflation reading we had with the CPI was very distorted by all the disruptions from, missing a month of data, basically, with inflation. So I think next week it's just seeing how much of those distortions shake their way out and to get a little bit cleaner read on inflation. I think today with employment, we probably shook out a lot of any of the distortions from the government shutdown on the employment data. I don't think we're going to get fully back to normal in terms of CPI with next week's report, but I think that's just getting something back to a more normal reading, which is inflation is still elevated, and then trying to piece out, are there any signs, like real signs, not some measurement quirk, but real signs of inflation turning the corner and really making, pointing towards 2%. I think, we're not going to get any super clarity on Monday, but hopefully we'll clear out some of the distortions.
I just moved it ahead. The tweets are coming out. Everybody's working off Twitter and LinkedIn now to get an immediate message. Invesco does that as well. Claudia Sahm, just, as the analysis comes out here, what is the efficacy of taking a 3-month moving average or taking 3 months of shutdown and non-shutdown data and annualizing that? Is that a good University of Michigan experiment?
Yeah, well, I have to say, with my recession indicator, I need a 3-month average of the unemployment rate. I can't even take October doesn't exist, right? So, we're in a moment and we've had more distortions in the data. So and it's a moment where you take these averages because you're trying to smooth out just some of the noise that comes from trying to measure a $30 trillion economy. And, it's been hard to even do that exercise. So I continue to, that is the way to think about this. You want to smooth out, and you also want to step back and look at trends, not just over 3 months. To me, the fact that we've had an unemployment rate rising gradually over 2.5 years by a percentage point. You got to look at the big picture too.
Claudia, thank you so much. Just really, really, really valuable. Her labor share of the economy is jaw-dropping. I can't say enough about it. I'll effort that chart out on Twitter and LinkedIn, stealing it from Dr. Sahm. She's chief economist, New Century Advisors. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Kristina Campmany joins us here, Senior Portfolio Manager, Global Debt at Invesco here. Kristina, you see a labor number here today that if you just look at the headline unemployment rate, it seems like the labor market's okay. Does that lend you to believe that the Fed may wait a little bit, give them some confidence to wait a little bit?
I think morning, and thank you again for having me. And I dropped all my things because I was so excited to log into the terminal and see what the data was.
You can come and go.
But I think we may be back to a Fed sitting on their hands mode and trying to decipher through the data. Mm-hmm. And again, we're still these are all noisy numbers. You're like, oh, great. Headlines 50. Well, revisions is minus 76, but the unemployment rate's better. And I think the Fed will probably be most focused and comforted by the unemployment rate. And the market's not really pricing much for the Fed really until we get the new chair in June. So I think that kind of remains our base case for the Fed here.
So 2025 for the bond investors, a really good year. The ag was up 7%, something along those lines. In 2026, am I just clipping coupons? Is that how I should think about fixed income?
Look, I think that there's still absolutely an opportunity in fixed income. I think the same pounding the table that we've had for the last year, that there is, especially in this environment, an opportunity for global fixed income when you take a step back. And that doesn't mean not the U.S. It means including the rest of the world, which I think investors typically do not do. But I think I think curves should probably still steepen, but there's still that gives you roll down opportunity, and there's value in the front end. And I think thinking about the long end of the market, we have to think about all these things. Back to the questions that we had at the beginning of last year. What are the administration's policy objectives going into midterms? What are they trying to accomplish? And then what is the impact on fundamentals? And I think there are so many moving pieces, but it's still about security and what's going on with, Trump seems to want cheaper oil and cheaper mortgage rates and those focuses. And then what do they mean to the market?
Futures up 26 right now. There's a bid to the market. Kristina, out past where Jerome Powell controls things, or maybe Mr. Myron controls things, what is the spread you find most efficacious? Don't give me the vanilla 2's 10. When you walk in the morning and tune into one of your 3 Bloomberg terminals, which is the spread that matters to you?
So lately we've been looking at 230s, and we laugh that in a lot of places, meaning across a lot of different markets, different regions, it's the whole curve, because we're in this dynamic that the front end offers value, right, in 2s, and the Fed has done some work and seems to be kind of patient for now, but it feels like the bar for whatever forward Fed that we have to hike is very, very high, and depending on who we get with the next Fed chair, the bar could be differing in terms of how quick we are to ease. So that's the front end. And then I think because of all of these fiscal dynamics, we're talking about increasing the defense budget spending and all of these things, the long end matters even more. So we really are zoomed out and looking at the entire curve and looking at 230s sometimes. And again, it'll shift depending on what's going on and what we've priced, but
how do you think about in 2026 as you look ahead here, U.S. versus rest of the world? Because, if you look at the stock market in 2025, as well as the U.S. did, international markets did even better.
Yeah.
How do you think about it in the fixed income world?
So again, we run global funds. So 2025 is an exciting year for us, that there's finally some ability to step back. And again, it doesn't mean that the U.S. is not investable and a great place to invest, but look at all of these opportunities elsewhere. And I think that still is the story and the underlying thesis, right? There is growth in the U.S. and there are positive dynamics here, but a strong U.S. is good for the rest of the world too. And I think that there are opportunities in foreign exchange markets as a standalone. There are certainly across fixed income markets. And I think in equities, again, we're not equity managers, our team, but I think that global story is here to stay. And again, when you zoom out and you talk about dollar cycles or all of these cycles, they're normally multi-year, if not 10-year cycles.
Off the radar is continental Europe. Goldman Sachs published this today. Sven and their EU team, that Germany's just simply better than people expect. We've heard that from German banks as well. Is there a hidden value in larger developed EU paper that I haven't talked about in what, Paul, 3 years?
Mm-hmm.
So I'm not sure. Again, it's hard to get super excited about just like European Union across the board, different countries, because of how tight things are. But I think your first point is right, that you had a lot of excitement in Q1 on the German defense spending and all of that. But whether you talk to people, certainly in continental Europe, but here too, I think there's a lot of negativity and people just don't believe that Europe can ever get out of its own way. And I think that there is more positive things happening there than is priced or that people give credit to.
But is it enough to play?
I think so. I think we are at a point that you need to see some proof in the pudding. I think maybe equities has it more. I think the euro itself has different, there are different dynamics there, and it's funding, and it depends what goes on with central banks. But I think there is still opportunities there for sure.
I think in 2025, I heard more discussion about emerging markets than I have in many years.
For sure.
Why is that, and how do you guys think about it?
Yeah, so we have a team that has a deep, long history of investing in emerging markets. But again, last year was certainly a time that it got broad interest. I think for us, we think about EM that you have to think of it that it can't just be a consistent allocation blindly because it is super volatile. But there are opportunities there. I think the places that stand out in particular are Brazil, Mexico, South Africa.
Aruba?
I don't know about Aruba, but
I'll let you know. I'm doing some due diligence next week.
I heard. We were supposed to go to Aruba for our first baby moon and got canceled back in 2016. So I've never been.
Okay.
But I think those markets, you have steep curves, high real yields. There are opportunities both in rates and in FX, and we are involved in those markets.
Kristina Campmany, thank you so much. Really, really appreciate it. Senior Portfolio Manager, Invesco. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
He is magnificent. The essay at High Frequency Economics is a yield-based analysis of the economy. It is what Carl Weinberg did at Lehman Brothers for decades, and it was just thrilled that he could join us here this morning. Carl, I love your research note in that you say the labor market's going to hover, but GDP may be light. Link the two together into the first part of 2026.
Hi, Tom. Good morning. Thanks for having me back on the show. It's been a while. We're at full employment. That's my assessment anyhow. Others might not agree with that. But even at a 4.5% unemployment rate, which I think, by the way, is going to go down in this morning's report, and we'll get a revision downward to the figure that we saw for November. But when we're at full employment like this, all right, the economy has trouble growing. The only way it can grow is either by immigration or getting more people in the labor force or by increasing productivity. So productivity was really strong in the third quarter. The economy grew well, but there's no promise that those productivity gains are going to continue into the fourth quarter. So GDP growth may be capped, if you will, by the economy being at full employment right now.
I'm more focused, folks, on the soggy GDP outlook of selected economists. Mr. Myron wants 6 rate cuts, 1.5%. Down, down, down. Is that a Carl Weinberg theme?
Absolutely not. I think Myron is wrong. I think he's abusing and misinterpreting the Taylor rule and the estimates and the importance of R star within the Taylor rule. R star certainly has come down, but potential GDP has also come down, potential GDP growth. So when you put the two together, there's no recommendation from the Taylor rule or anything that I know about economics for the Fed to continue to cut rates with the economy at full employment.
This is Carl Weinberg and Michael Ferroli at J.P. Morgan. This phrase, potential GDP, none of these people within the Trump administration talk about it. It's like they're blind to it.
Carl, the focus obviously today will be on the labor market, but the other side of the Fed mandate is inflation. What's your inflation view? Are you concerned that we may see stickier inflation than maybe the market's discounting?
I'm concerned about more inflation as 2026 progresses, because if the economy continues to grow, but it can't find the workers to make it grow, then we'll have too much income chasing too few goods, and that will put upward pressure on prices once again. To me, that's what the Fed should be thinking about. To my clients, that's not what the Fed is thinking about, but in my view, that's what the Fed should be thinking about.
So given that backdrop, how do you expect the Fed to behave this year? Is it one cut, two cuts? Do they need to be more aggressive or less aggressive?
I don't know. I mean, that's really a big question. First of all, we have 4 new voters on the FOMC.
Yep.
Right? We've lost both of the voters who dissented from previous rate cuts, and at least 2 of the new people coming on board may be more inclined to ease rather than to hold steady, even as soon as the next meeting. All right. Against that, Fed Chair Powell still commands probably 3 votes on the FOMC out of the 12, and that's the swing, if you will, between those who will ease and those who will settle. So I don't really know where they're going to go on this, but what I'm hoping to see as we move through the year is a change in the perception that payrolls are slowing because the economy is weak. That's where the Fed is right now. To payrolls are slowing because the labor market is tight and there just aren't enough workers to hire to keep payrolls growing quickly.
All right, Carl, we got some time left here. I want to get you on much more in 2026. You should see where he lives. I mean, I took the Nash Rambler once.
Yeah.
I had to put, the chains on it in the winter to get up there. It's up the Taconic, it's like God's country.
Yeah, sure.
I mean, it's beautiful.
Yeah.
Carl, in your note, and I got 8 ways to go here, Carl, but I got to go to your legendary reputation on the Pacific Rim and on crisis. Are your radar up in 2026 for China or other currency or debt upsets?
I'm on the alert for a lot of things coming from China this year that we've never seen before. All right, if you read the IEA's critical minerals outlook, I believe is the proper name of it, okay? China sits at the root of every supply chain for every critical material for every Western economy. No exceptions to that. So, all right, this is a weapon that Xi tested with rare earths last year, that he's testing right now again with Japan. And Xi has things that he wants, and I think he's going to asking for them with leverage. I think that's the risk for China in the new year.
Carl, not enough time. Thank you so much. Carl Weinberg with us. High Frequency Economics, just definitive research report. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The newspapers with Lisa Mateo. Good morning.
All right, I have a question for you. Which do you think has the priciest homes? We're talking Aspen versus Palm Beach. Okay, this is it. Do you go mountains or do you go
I'm going
sunshine?
to Aspen in March.
Okay.
So I'll let you know.
Wait a minute.
Yep.
You get back from Aruba?
Yep.
Do you only go places that are letter A?
Yes, exactly. We're doing A there this year. And I'll tell you what, we got the quote from our guy in our group who always gets the condo for us.
Okay.
Noticeably higher than where we usually go. Which we go to Park City and Vail and Tahoe. Noticeably more expensive in Aspen this year.
Okay.
So what's the answer on Palm Beach?
The answer, okay, so here's the reasoning behind it. So the Wall Street Journal kind of did this look into both. So Aspen, the data shows 34 deals above 20 million last year, up 161% from 2024. So if you compare the price, right, you look at the medium single family home price in Aspen, about 14 million during 2025, the third quarter. 9 million in Palm Beach, but then you have the tax factor too, right? Florida's the tax haven, so they have that advantage. Colorado has like a 4.4% state income tax, but then you have to take into consideration the insurance factor too, where Florida it's much higher. So you kind of have to weigh all these factors and figure out which
have you
is
chosen
better.
For the Mateo clan?
I like the sunshine. I don't know, but I'm a mountain girl, so I'm stuck.
Is there anyone in Palm Beach who doesn't do Pilates?
Probably not.
Probably not. Next.
It's the central part. Okay. Wearable health trackers.
Oh, please.
yes. Okay. So popular.
Does she have a new intern?
This is great. This is a great story. It's on the terminal. You have the Oura Ring, right? The Apple Watch, Garmin devices, Fitbits, all this stuff that can track you. Experts are saying, you know what? They can provide some great health information, like your sleep status and all this stuff.
Sleep status.
But there's a but to it now. They're saying data overload is causing people anxiety. So they're starting to get anxious, like they always think maybe something's wrong with them, or maybe they're sick, or maybe they're doing this, or maybe something's wrong. So that's kind of the downside of it, they're saying, with some of these wearable trackers.
Everybody's wearing those rings.
They do.
Half the people come and sit next to me in this studio, they've got their ring
And
on.
they have the ring.
Yep.
I know.
What is the ring?
It's the Oura Ring.
I'm so out of it.
We have to get you one.
Yeah, that's what we'll do. We'll get an Oura Ring for Tom.
Yes, you can see it if you're watching on YouTube.
Yes,
It's on YouTube. There it is.
There it is.
So they
It's
have
beautiful.
I've seen the rings
And
everywhere.
it tracks
I
everything.
didn't know that. They have data tracking?
I'll point them out. I'll shame these people from
Do
going
they,
forward.
do they track Afterthoughts Visa expenses?
Yeah, exactly. That's what we need.
It's a great tool,
Okay.
but it can make you a little bit,
Okay, great.
crazy.
You're 0 for 2. Save yourself. Give me one more on Jobs
this is
Day.
a good one because, I have Paul going off to Aruba.
Yep.
So I'm going to set the scene before I get to the story, okay? Hit it, Ken.
Wasting away again in Margarita.
There we go, Paul. Okay, there's a reason why I'm playing this. It's because Jimmy Buffett's old recording studio is wasting away in Margaritaville. Okay, it's causing some controversy.
Oh.
So here it is. It's over in Key West, right? It's this worn out bunker building, no windows. But Jimmy Buffett recorded dozens of albums there, right? So many famous names came through there. But since he died in 2023, it's become this controversy because they're deciding what to do with it. So they bring this proposal. They're asking people for their proposals on what to do with it. And some people are saying, you know what? They want to turn it into a bar. But some people are saying, you know what? No, it should be like a museum or like a place. Keep it as a studio. It's a piece of history.
It's a huge deal.
Yes.
The Chateau of Elton John outside Paris is in massive disrepair. They're trying to figure out what to do with that. There's the whole Montserrat Caribbean thing.
Yes,
Same
yes,
thing.
yes.
George Martin, it's all in disrepair. So that was very good.
Yeah.
She saved herself.
Yeah. Jimmy Buffett always says.
Jimmy Buffett on a Friday?
In honor of Paul. Do you have flip-flops on today?
No, but I got the flips-flops ready. That's the only shoe I'm bringing down.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.